Hey everyone, and welcome to a stream for Reddit. And we're going to be trying to value the company. I think this is going to be a pretty challenging one because I looked briefly at Reddit's numbers and the company is unprofitable right now. So it's going to be a little bit TBD to see how successfully we can build this model, but definitely going to do my best. So just as normal, I want to first go over the agenda. So I'm going to start off with a situation overview, then go into some trading comps, talk a bit about the sponsor for the video, Wall Street Prep, then go into the street-based DCF, including the exit multiple method, which we don't normally do, but I think it may be especially relevant for Reddit. And then WACC mid-year convention, discuss the price a little bit. So that's what we're going to be going over today. And first, going into the situation overview, let's look at Reddit's stock, which recently IPO'd about, I guess, a month ago and had a pop of, I think I saw down here, about 50%. And then since then has kind of been on a downward trend and slightly rebounded recently. I think generally speaking, I would imagine that Reddit may be a bit overvalued right now. So the market cap is around $7.3 billion. The company is not even profitable yet. And so it's going to be a challenge for Reddit to maintain this valuation, in my view, unless the company really ramps up its profitability. Now, with that said, there's a lot of good things to like about the company as well. So let's kind of go into the bull case. So one is highly active, engaged, and growing user base. I'm actually a big Reddit user myself. And so I think that the company is definitely here to stay. And I went into something called the 424B4. This is like a filing that companies have to issue once they are going public. And you can easily find it on bamsec.com. If you go into bamsec and then you type in the company, in this prospectuses and registration section, you can find these kind of filings. So I thought this was kind of interesting. You can see this is daily active users, and it's been generally increasing from about 55 million all the way up to 73.1 million. But I bet you what also has happened here is that Reddit knew that it was going to knew that it was going to IPO and really tried to ramp up its daily active user numbers and probably spend a ton of money with like marketing and stuff like that. Or maybe there's another reason, but that's what I would just guess. You can also see that there's been a big increase in US users and also rest of world. So over time, it's kind of like evened out, right? Number of US users versus number of users outside the US. I also wanted to do a quick mic check to see, let me know in the chats if everything sounds okay. I think it does, but just wanted to make sure. The other thing that I think is kind of relevant / interesting here, which we're also going to go over, is ARPU, average revenue per user. And this has been relatively on the increase, but kind of choppy, I guess. But, well, I guess this is more seasonal. Each quarter it seems like it's a lot higher because people are just spending more. And then you can also see that the US average revenue per user is higher than rest of the world. That's fairly consistent across all companies. But so I think that is, if you want to believe in Reddit, the bull case. Also international expansion as the company enters new markets. That's going to be something that is going to be a big part of the bull case for Reddit. Next, untapped monetization potential, including potentially AI training data. So I think there's been a lot of news about how Reddit is selling its text, like all the data that it has, the information from its subreddits and everything, to AI companies. And this kind of goes into the bear case. Maybe I should start with number 3. A lot of people are saying that Reddit, if they sell a lot of its information for AI companies, they're kind of selling their own future, where later on when they normally might just search like how to cut a mango, Reddit, they'll instead just go to AI, and maybe that's already happening. But they're saying people are thinking that AI could replace a lot of what users use Reddit for, which is a potential bear case. Another thing, competition for attention from larger, more established social media platforms, which challenges user retention and growth and monetization. So Facebook, TikTok, Instagram, Pinterest, even like all these social media platforms that are much larger and also a lot better at monetization, which is bear case number 2. Reddit isn't known for being super, super great with monetization. And so that is another thing that the company really needs to figure out. So quick notes and reminders before we go into the model. So this model will be available for free to download after the stream ends. Usually takes 1 or 2 days, so please be patient with that. Thank you in advance. This is also high-level DCF based on street-based estimates, not financial advice. And then also, this is just something like an exercise, whether you are trying to learn how to model or if you want to use this as one piece of information for your own investment work that you're doing, or you want to download the model and work on it yourself. That's really what this is for, rather than this is the one thing you should use in order to base a decision whether or not you want to invest in Reddit. If in case you want financial statement, Excel shortcut, DCF tutorials, etc., then they're all in the description below. You can also check out the live tab on my channel for more DCFs for other companies. And let me kind of show you what I mean here. It's a lot easier to check what companies I've covered if you go to the live tab. Kind of lagging a little bit. Anyway, the last one is I'm working on an investment banking course, and I'm working really hard on it with my MBA classmates from Wharton, come from Evercore, Goldman Sachs, and another from JP Morgan M&A. And I was also the recruiting captain at JP Morgan for 2 years. So for UC Berkeley recruiting, that is. And so I'm bringing all that kind of experience to the course, and I think it's going to be really good and helpful for a lot of people. So you can see here, the Reddit one is up here right now, and you can just kind of scroll through and choose whatever companies you feel like are relevant. But I will say that, or the ones you want to look at, but I will say that, of course, the numbers are a little bit stale, but especially the more recent ones should be a little bit more relevant. So that is the situation overview and some notes and reminders. Next, I wanted to go into trading comps. So trading comps are another method of valuation that's known as relative valuation, where you're looking at other companies and seeing how they trade, what their financial metrics are, to kind of triangulate towards what your company's valuation should be. So a big thing when you are looking at trading comps is you don't want companies that are way, way bigger because they're just totally different. But in our case, I did want to include Facebook/Meta because I think it's kind of the company sets kind of like the gold standard of how you should monetize your users. And that's why its market cap is so big. And I feel like in a very, very optimistic scenario, Reddit should kind of basically work towards the margins that Facebook has, but I don't know if they're really achievable for Reddit. So let's not place too much stock on Meta here, but I do think these other companies down here are a little bit more they're smaller in size, a little bit more applicable to Reddit in terms of comps. So first off, looking at the 52-week high. So let me zoom in for you guys a little bit. So if you look at the 52-week high, you can see that Reddit is about 70%, but it's only been trading for like a month or so. And then a lot of tech companies these days, it seems like, have been kind of beaten down a little bit, not like a ton. You know, if they're in the high 60s to 80s, that's certainly not like the worst. So yeah, that's kind of how a lot of these companies have been trading. And you don't necessarily look at these numbers by itself and think, oh, it's trading at a lower percentage of its 52-week high. It must be a steal. Usually there's a very good reason why it's trading lower than its 52-week high. Next, looking at revenue growth, it looks like Reddit is pretty good here, kind of near the top of its peers. And I think I formatted this incorrectly. Yeah, so you can see it's green here. There's like an anomaly here for Roblox for 2023 to 24, but if you were to delete that, then you can see Reddit's basically growing pretty quickly, which is a huge positive for the company. Gross margins, this also seems to not have been formatted correctly. Sorry about that. But you can see that gross margin, Reddit seems pretty good. But where the company really suffers right now is in EBIT margin or EBITDA margin. So this is basically after you subtract out a bunch of your operating expenses in addition to your cost of goods sold. And this is the true test really before net income as to whether or not your company is profitable. And it looks like if you look at the EBIT and EBITDA margins 2025 next year, it seems like Reddit's getting there and really making a focus towards profitability. But as of now, it's basically making no profits. Compared that to some other companies like Facebook, as I mentioned, the gold standard. Snapchat is on a downward trend. I really don't have faith in that company, to be honest. Roblox, I included because it's kind of like a community-ish based gaming platform company. Pinterest, also not that great for EBIT, but EBITDA margins look really good, actually. Match Group, 36%, pretty solid. So basically, Reddit has a long way to go, probably at least a few years in order to be profitable. And I think this is what's going to make building Reddit's DCF a little bit challenging because we're going to have to guesstimate a lot in terms of margins. Next, if we look at trading multiples, this is really the crux of trading comps, really. Like, how is the company trading in comparison to other companies? And you can see here in red, so basically 7.9x means that you're paying $1 for every $7.90 that Reddit makes in revenue. So it's, as you can see, it's more expensive than Meta, more expensive than all its peers here on a revenue basis, revenue multiple basis, gross profit, and EBITDA. So, well, EBITDA, I would say because EBITDA is so low, you can actually probably just really ignore this for Reddit. It's not really relevant. But basically, if you even just look at revenue and gross profit, it's trading a lot higher than a lot of other companies. And this tells me that probably Reddit would be a company I would short, just purely based looking on this. And I think it kind of speaks to me that the company may be overvalued, but we'll see. Next, premium or discount to historical multiples. This is basically where we're looking at in the past, compared to the past 1 year, 2 years, or 5 years, is the company trading at multiples higher or lower, essentially. So if we look at this, well, it's not super relevant for Reddit because it's only been trading for a month, but you can see that a lot of, it's kind of all, these companies are all over the place, but generally speaking, like Facebook/Meta, for instance, is trading higher than its historicals, while there are several companies here that are trading lower than its historical multiples. And again, there are really good reasons for that. You can't just use this information by itself, but I think we're going to kind of reference some of these figures later on as we build out our DCF. So let's go back to our agenda. So we went through trading comps. Next, I want to let you guys know about Wall Street Prep. So they recently actually announced a certification program called the Hedge Fund and Buy-Side Investing Certificate Program, alongside Wharton, which is where I'm getting my MBA. Well, actually, I'm graduating in about a month. So maybe by the time you're watching this, I'll have already been graduated. But it's an 8-week online course that you can sign up, learn at your own pace. And let's kind of look at who's teaching it. So Wharton professors, Brett Coffron, who has experience working at Citadel, D.E. Shaw, and a few other buy-side shops. And then keynote speakers from Howard Marks, who is a co-founder at Oaktree, and then several other hedge fund kind of investors. And Howard Marks, actually, I met him at a Wharton event as a, I guess, kind of fun fact. He also has a really good podcast called, I think it's called The Memo. But if you look up like Oaktree or Howard Marks on Spotify, Apple Podcasts, or whatever, you'll be able to find it. And it's a really good investing related podcast. Next, you can see all the faculty and speakers. But I wanted to kind of scroll down to what you'll actually learn in the course. So investment fundamentals, there's 2 parts, a lot of like theory, but then there's also fundamental foundations. You're going to also start building a model as you would on the buy side. Then you start to learn how to develop theses. which are super, super important. Then there are advanced concepts, and then something that brings all of it together. So that's really the course. Last thing I wanted to mention is some of the additional perks from joining this program. So you can join this Wharton Wall Street Prep only group on LinkedIn. So you can kind of do some networking, get a certificate you can put on your LinkedIn, and then this cross-program networking events. So that's really the course. If you want to check it out, I'll leave a link to it in my description below. And you can also use my code RareLiquid to get $300 off of the course. So that is Wall Street Prep. Check them out if you're interested. And then now let's go into building this model from scratch. So I'm going to zoom in here a bit for you guys. And bear with me a little bit because whenever I stream, the screen can lag a little bit. Hopefully it doesn't too much for you guys, but it does a bit on my end. So this is the Reddit DCF. We're going to start off with the ticker. They have this information, and I'm going to actually probably copy paste some formatting from a previous DCF just to save some time. And I see you guys, I'll answer some questions if you guys have any in the chat. And I see a lot of love from you guys right now. Thanks so much for you guys' support. I actually, Molly, if you're still there, I went to Turkey last fall and had a really good time there. So definitely want to probably go back in the future as well. Okay, so 4/26/24 is the date today. So we're going to start off with, as usual, we'll have like a section for our assumptions. Let me actually copy paste that here. And then we're going to do that maybe a little bit later, but we're going to have first here our income statement. And then later on, cash flow items. And then later on, our DCF. Okay, so well, let's first look at the numbers. So I pulled together the income statement, the historical income statement for Reddit. We only have 4 years because the company recently went public. And you can see revenue growing pretty solidly. The real just big important thing here is that EBIT is negative. Like it's a unprofitable company, which really makes it challenging to build a proper DCF. I think we may have to do like a 10-year DCF versus in the past where we've done 5-year DCFs. Cash flow statement we'll be using later, and then we have some Wall Street estimates. Okay, so we're going to have revenue, percent growth, EBIT, percent of sales, and then taxes, tax rate. All right, so we're going to start off with the earliest year we have, which is 2020. I see a question, how do you do a sensitivity analysis for this? If I have time, I will do a sensitivity analysis. But I actually have to catch a flight in like a few hours, so I'm not entirely sure how much time I have. So I'll do my best though. Okay, so let's basically just start linking to the figures here. So 2020, as you guys probably know by now, if you have been watching some of my streams, I like to color code my cells because when this is like common practice when you're working on the job, basically. Green at JP Morgan meant that it's linked to another cell or another sheet. Okay, so and then 2024, we have some of these figures. So let's look at the growth rate. Actually, so what I want to do here is okay, so interesting growth rates, right? But we can't necessarily trust a lot of these estimate figures, which I'll explain later, but seems like the company has a respectable growth rate and potentially also in the future. Let's next look at EBIT, operating income, which is just trying to see what other stuff is in here. Operating income 2024. This is when the company is just starting to be profitable. And then here is the EBIT margin. So again, another, like, this is a clear example why you can't just look at street estimates and take them for face value, because why would the company go from 15% to 0%, right? There's just something funky going on there. Taxes, income taxes. Well, yeah, the company's not profitable, so it's pretty much zero for a while. And there's also going to be what's known as net operating losses. The company doesn't have to pay taxes on its profits for a while. I don't know. Okay, tax expense also here. Yeah, also probably not super reliable, but basically taxes aren't going to be a huge part of our analysis. Okay, so basically it's like 0-ish%. The tax rate, base it off of, so we're going to base off our tax rate off of our pre-tax income, but I don't know if we're necessarily going to use all these figures. We'll just include them here for now. Yeah, this definitely not, because it's negative. You wouldn't ever have a negative tax rate. That means the government's paying you money, basically. So yeah, these figures are all pretty irrelevant. So what I'm going to do is if this formula is less than 0, I'm going to have it be 0. If not, then we'll use the figures. Oops. Oh, this is actually a different formula. So this was actually so again, if this formula is less than 0, negative tax rate, which is not likely or is not possible, then we want 0%. If it's higher than 0, then we're going to want greater, like we see here. Okay, so we have our income statement items. Oh, I see a comment that says low voice volume. Let me try moving my mic up. Sorry, I didn't know that actually. Is this a lot better? Let me know in the chat. Cash flow items, let's start to build these out as well. All right, cool. Sounds like the volume is better now. So I'm gonna have DNA here, % of sales. CapEx, % of sales. Net working cap change. in net working capital. And we're going to check percentage of sales and percent of change in sales. So let's go into our historical DNA. So starting 2020. Yeah, I would imagine that the company doesn't have a ton of DNA because it's a software company or tech company. So it won't have like a lot of like plant, property, equipment type of stuff, basically. Same with CapEx. I like to keep all my numbers positive, even if they're outflows or negative figures. Personal preference, but basically you can see here, DNA and CapEx. So for your unlevered free cash flow formula, you add DNA, subtract CapEx, and you can see the numbers are like 1%, maybe 2% of revenue. So they're essentially going to cancel each other out. So you can almost like just ignore these two. And let's see what changing net working capital looks like. So in terms of percentage of sales, okay, somewhat significant actually, versus change in sales. All right, so between these two, kind of hard to know what exactly to use actually. But I feel like this is kind of an anomaly. Seems a lot higher than the other years. So I'll kind of think about that later. Okay, but for now, basically we can start building out the DCF. I'm wondering though, maybe if we should break out any of these other items too when building out our EBIT. I think it's fine. Well, just something that I was looking at earlier was, okay, well, I was trying to look at gross margins, but I think generally they're pretty stable at around 86%. But if we look at the company's spend on SG&A, they're spending about like 53% or so of their revenue on research and development, and then spending about 48 or 50-ish% on other SG&A, which could be things like employee costs. They might also be including marketing costs and stuff in here as well. But anyway, something I was looking at earlier. In terms of the DCF, I think we may build it for 10 years because it's going to take a while for the company to kind of get to a more steady state. Actually, let me see. Because the more years you project out, the more inaccurate you probably will eventually be, just because no one can predict reliably exactly what's going to happen. I'm also going to format this. So this is 1 year. This would be, okay. is happening here? This is weird. There we go. Okay. So A just stands for actuals, and then E for expected, so future. So let me just first set things up, and then I'll kind of decide how many years and stuff like that. So we're going to have the same thing that we built up here, but then we're going to have our cases as usual. So conservative case, base case or street, and then our optimistic case. And as I do this basic stuff, I'll answer some questions in the chat. So I see, are you going to do any risk analysis videos in the future or strictly DCF? So not exactly what you not exactly sure what you mean by risk analysis, but I've been meaning to make a LBO stream video for a long time. I know it's been taking forever, but I need to prep for it basically, and I haven't been able to make a ton of time to do that. And so but I'm graduating. I'm going to have a ton of time once I'm out of school. So basically, I'm going to do that, build also 3-statement model. So that'll be coming soon as well. Risk analysis, not sure what you mean by that. Unless you mean like sensitivity analysis, which I have done in some DCF videos in the past. But I'm going to make other kind of modeling videos in the future. I recently bought myself a MacBook M2 for an upcoming accounting job. Do people in IB and accounting use Windows? Yes, definitely stick to Windows. Although I use Macs for my personal life. I just kind of got used to it. And then I use my PCs almost strictly for modeling. Okay, so let's first link up to what we have already built out. And when you're linking to the same sheet, normally make this purple. So you can decide if you want to basically just link to everything, recalculate everything. Honestly, it doesn't really matter as long as you're kind of consistent. So these are basically 0%. Okay. So all right. So the tricky thing is just figuring out how many years to build out this DCF. It looks like we're probably going to rely on 2024, 2025 estimates. And then after that, kind of like probably unreliable. And so let's say, so let's see how many years we would have, what this would look like. So the pros and cons of doing a longer DCF is that you'll basically be able to grow your company, especially when it's, I mean, Reddit has been around for a while, so I don't know, I wouldn't necessarily call it like a hyper growth company, and it's not really growing at that kind of pace anyway. I mean, 20% and so is high, but it doesn't look like it's going to sustain that for more than a few years. And then when it comes to EBIT, this is like what's the most important thing. And like basically, when is the how long will it take for the company to reach a margin where it won't really get that much higher, essentially? So when does it kind of mature into like, when does it really get to become like a more mature company and have higher margins? And so if we do believe in these numbers at least, and the company grows to around 8% EBIT margin next year based on street estimates, somewhere around, probably around like 8, then to like, 15% is possible, but I'd say that's probably like a very rosy scenario. And then, so if it's around 5 years, if it like works super hard on profitability, gets to around 15 to 20%. Okay, I think we'll work on the 10-year DCF. I think that's what will be best here. So I'll do a 10-year also because it's a bit different than what we have been doing in the past, which have been a lot of 5-year DCFs, given that the companies have been pretty stable. So this should be hopefully helpful, but not much really changes in terms of like what we're gonna actually include. So I'm gonna copy paste from an old model. Oops. So I see a question. Best way to start financial modeling, which type of model should I start with? I would first honestly start the basics is accounting. So even before you start modeling, I would say make sure you know your accounting. And then after that, if you want to do baby steps, then I would probably start off with comps, because that's like super easy. And it's not really, comps isn't really modeling, but if you don't know that, then I would start there. Then I would probably go to the DCF really. And I would start off with like a higher level one. This is a high level DCF as well, but maybe one without like cases basically. I would just start off with no cases. Okay, so I'm gonna look at on FactSet, go to our estimates, and then see how many brokers kind of fall off. So we have a good number for 2025. So 2025 estimates look pretty reliable. 2026, not that bad actually. Better than I thought. 2027, a lot less. So it's starting 2027, I'd say for sure numbers are pretty unreliable. So I'm probably just going to ignore a lot, if not all, of the 2027 figures. Okay. Base case, revenue growth, we're going to stick with what the street tells us here. One thing that I don't really like is how the revenue growth figures are like 24%, 23, 25. Like, unless the company you just know the company is going to really like get on a rocket ship somehow in the future because of some development, there's no reason why revenue growth rates should really be increasing like this. So, I mean, it's definitely possible. It's just that I don't once you have a larger and larger revenue, the growth rate becomes harder and harder to sustain or to increase versus previous years, right? So I think what I want to do for here, basically, we need to kind of figure out in 10 years, what kind of company will Reddit be and what kind of growth rate will it have in 2033? And for that, I think let's go to our comps. And we can kind of look at if there are any more established companies that we can imagine the Reddit being in the future, I guess. So one company here is Meta, right? Meta is a huge company and is still growing double digits, which I think is pretty remarkable. I think this is like best case scenario for Reddit, for it to be growing at like something like 13% in 10 years. Maybe like in between here, maybe like 15% or so. That would be a super, super optimistic scenario in my opinion of Reddit. So maybe we use that as an optimistic case and kind of work from there. I think in a more realistic case, you can see some of these companies, while they're not perfect comps to Reddit, I think it's much more realistic that the company in 10 years is trading somewhere in like the high single digits. So actually, I'm going to kind of use some of these numbers to build. I'm going to kind of hop around. So in 2033, in year 10, I'm going to assume that Reddit's revenue growth is around 14% based off of kind of what we see here. Maybe I'll make it 13% just to make it a little bit more, have like more foundation of what it's based on. So we'll base it off of Meta's 2024 to 2025 revenue growth figure that we have right now. We may need this down here, actually. We may need to change things. So we have that. For our base case revenue year of 2033, I think we can kind of look at these other companies. And while they're not necessarily all older than Reddit, I do think like these are kind of where Reddit can be in a base case scenario. And I think this could potentially still be a good thing for the company. Let's call it 7%. And then let's say, that might be a little bit too low. Call it 8%. So basically a 5% difference here. And then in our super, I guess, conservative case, we'll call it 3%. It's basically 5% increments. And all of these, I think, could happen in 10 years. We just never know, really. So let's kind of link to each of these. I know I'm kind of hopping around across cases a bit differently than I do normally, but I think that's because we're projecting so far out into the future. So we're also going to treat each of these years a little bit differently. Each of the first few years a little bit differently. So 2024, right now we only have like 7 months left. Time really flies. And so, but the 2024 figure I think is the most reliable. I'm going to assume for basically 2025 to 26. Maybe I'll just call this 33. No. 24 to 26, basically we're going to rely on our street estimates, even though they're a little funky. And then, actually, I don't know if I want to do that. Yeah, actually, I don't really love how this is going up. So I think it makes more sense to me for this to slowly grow down a bit. So 2025, we're going to use here because I think this trend makes sense. Plus, it's just 1 year out into the future. So those make sense to me. I think maybe from here is when we just start growing down to this figure. So we're going to get our previous year and then subtract the difference between 2025 minus 2033 and divide this by the number of years. Guess that's 21%. Okay, this seems like reasonable for this case. 2024, 2025. So I want to be revenue. So 2024 to 25, I think we can just be a little bit more pessimistic and optimistic for these scenarios. So I'm going to decrease and increase the first 2 years by 10%. Do the same thing for our optimistic scenario. See how this looks. Yeah, our optimistic scenario is going to be very optimistic. Okay, so I also want to make this something I can copy paste down. So I think what I'll need to do is anchor the the column. That should allow me to copy paste this down. Oops, no. Cool. So we have our optimistic scenario, and then let's also get our conservative scenario. Okay, so pretty wildly different scenarios compared to a lot of the other models we built in the past. And I think if I do have the time, I will build a sensitivity analysis because, and we will have a pretty wide range probably for valuation. But I think this is important because, as I stated when I first started building this out, I do think that Reddit likely is overvalued right now. So it'll be good to have this pretty optimistic case in order to see if we truly, truly believe in Reddit and it just goes beyond our expectations. What does that justify today's valuation? Right. So that'll be kind of interesting to see. So revenue, we're going to have our switches here. So that's simply, we're going to use the offset function. So offset, so reference the cell that you're in, then how many rows you want the switch to go down to when you're changing the switch. Press F4 to anchor. There we have our revenue figure. Cool. And then the most important, second, after revenue growth, I guess like the second most important part is your EBIT. So let's build this out. I think this will also be a little bit tricky. So 0%, 8%, 15%. I think this also seems a little bit aggressive. It is the street base case, so we'll go with that for the first 3 years, I guess. So let's see it where, again, let's kind of use comps to see where Reddit can get to in the future. So a super, super blue sky scenario is that Reddit gets to Meta's EBIT margins of like 40%, which I think is highly, highly unlikely. There are other companies, Match Group, pretty profitable, it seems. But I do think that for a while, Reddit will probably be stuck in this like 10 to 15% range. And if it does really well get to like the 20s and high 20s or something like that, it's really hard, I think, in order to be like a super, super profitable tech company. So 15% by 2026 to me seems very optimistic. I don't think we want to necessarily believe that. We can definitely go with what we have here from 0% to 8%. The company is probably focusing a lot on profitability because it is a public company now. But in 2033, basically in 10 years, where do we see Reddit's EBIT margins? So in the base case scenario. So what I would think is, if we look at our comps here, probably something around like 20% seems reasonable here. So it's higher than what these companies have achieved right now, but I wouldn't say like Etsy, Yelp are like the top tech companies, right? Like they have relatively low market caps for a reason. So for me, 2033, 20% seems fairly achievable. And let me link to that up here. I think in a extremely, while somewhat achievable, I think like a 30% margin would be, like if we look at Meta, 39%, I guess this is kind of like the cap, right? You don't really ever imagine a company going higher than that. But I think over 30% will be relatively challenging for Reddit, so I don't really want to go any higher than that. And then conservative scenario, maybe actually in 10 years, a lot can happen. So maybe we increase this by 35%, 25%, and then make this 20%. I think that's makes sense. And then, yeah, this way we'll have like a wide range when we're building out, when we're trying to look at what price the company might trade at and stuff. And we can also change this around if it seems like it's too aggressive, conservative, etc. All right, so as I continue doing all of this, let me try to answer some questions I see in the chat. I'm a finance graduate, but I'm not familiar with comps. So it's COMPS. Comps are trading comps. Once I publish this video, if you go to the beginning section, I'll have timestamps later as well where I talk about comps, and you can kind of see what I mean by that. Where do you get your growth expectations from? Revenue. We kind of went through that throughout the stream, so I would recommend that you kind of go back. I have just been looking at similar other comparable companies and trying to figure out like what seems to make sense based off of other kind of more mature companies like Meta. How to forecast fixed asset depends on the asset. What do you think of Tesla's new quarterly announcement? I actually haven't really looked at it. Your voice is so low. Are you guys talking about voice volume, or are you talking about, how do you describe it? Like the lowness of a voice? Because I can go closer to the mic if the volume's not good. Okay, so while I wait for you guys to let me know about that, I'm going to see, or this is going to be building towards, so let's see. Interesting, this actually works. So I guess this formula works, but normally how I build it is actually you want to add the difference from R51. I guess it works because you're subtracting a negative. Okay, and then for our 2024 to 2025, I think we'll do something similar here, except margins are not as variable as revenue growth. So I'm going to make it 95% and 105%. Yes, this video will be saved on the channel. If you go to the live section of YouTube where you go to like view people's streams and stuff in their channel, I wonder if I still have it up. As that loads, I'll show you guys. But anyway, here we're going to multiply this by 95%. And then this one by 105%. We're multiplying to basically 0, so not much should really change. Okay, so, and then now we can copy paste this formula, and let's kind of analyze to see what things look like. So we are, for our base case, a little bit more conservative than our what we see here with like 15%, because I don't think getting to 15% is super likely. But in our optimistic scenario, we basically say in a year afterwards, then it gets to 15%. I think it'll just be very interesting to see how quickly Reddit in the next few years is able to maintain and improve its profitability. I think this conservative case does grow super slowly. May not be as probable. I think this this optimistic case, like Reddit would be very happy with this optimistic case. Okay, so let's again build our switch. Multiply this by our revenue. Okay, now taxes. So let's see here. 0%, but it's only going to be 0% for as long as the company is unprofitable. Okay, this is going to require net operating losses, but it's been so long since I did that. Oh, right. So here, if you go to live, you can see all the different models, and the Reddit one will be here later on, basically, is what I was trying to say. Okay, I'm not... Let's see if they talk about net operating losses here. Okay, so we have incurred substantial losses under blah, 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 carrying on regenerated in tax years, may be carried forward for 20 years and may offset taxable income and federal. NOLs we generated may only be used to offset 80% of our taxable income annually. As of December 31st, 2023, we had net operating loss carry forwards of approximately 216.7 million and state net operating loss in blah 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 of 177.1. Federal and state. Our state net operating losses will begin to expire in 2026 if not utilized. Oh, that's pretty important actually. Our federal net operating losses can be carried forward indefinitely with utilization limited to 80% of our taxable income. Okay. Oh man, this is actually a little complicated. But basically what net operating losses are when you are unprofitable as a company, you can use your previous losses to offset your future tax payments. So meaning that if Reddit this year were to, let's say, make 217-ish million in profit, they could essentially use net operating losses to not pay any taxes. Although things are a little bit, this is just for federal and state, but okay, anyway. So let's see what things look like here. I guess that's also probably why Reddit is going to work really hard to be profitable in 2026. Maybe that's why the profitability is so high here, because net operating loss carry forwards expire or will begin to expire in 2026. So not all of it, but a lot of it potentially. So I would imagine the company is going to want to utilize this tax benefit and actually really ramp up profitability as much as possible. Let's see if there's like more detail as to when they start to expire. Okay. Basically, I want to make sure that we're using the right tax rate because it is very important. And it's going to be 0%, or it has been 0%. Or yeah, the company has been unprofitable for so long that now the company is going to start, when it start making profits, still pay 0% in taxes until the net operating losses are used up. I'm trying to see basically until what year. So in total, they have 217 plus 177. So that's 454 million in net operating losses. So up to that much is like around 391. Okay, so basically we're gonna have to build out like, okay, so I'm not gonna probably build this out as detailed as I should, because we don't have information for how much, like what percent the federal tax rate is versus state tax rate and all of that. But I do want to incorporate the NOLs. So as I read through this, what I'm going to do is just kind of treat this all as one, like assume that this is not broken down into state and federal. So, okay. I haven't done this in a really long time, but let's call this net operating losses. Let's call it actually beginning and not net operating losses, usage of NOLs, ending NOLs. Okay, and then we're gonna say that we, let's have this in our, maybe in our assumptions somewhere. Actually, so our ending NOLs is here. So it says as of December 31st, 2023, we had 216.7 plus 177, but you can only use 80% of the federal. So I'm going to take 80% of 216.7 and then add 177.1. I'm going to assume that the company, in order to take advantage of this tax benefit, is really going to use up all of this, regardless in what order. And I'll leave a comment here. So page F32. Okay, so we're starting with 350. And basically what we're going to want to do is pre-tax. Well, I assume the company has no interest anyway, so EBIT might be the same thing as EBT. Look at the company's financial statements real quick. Oh man, it's already been an hour. Okay. Sorry, the screen is lagging. Where is the table of contents? Okay. Okay, cool. The company has no debt. So what I'm going to do here is basically if the beginning balance is, let's see, if the beginning balance is, the usage of NOLs. So if the beginning balance is greater than 0, then get our EBIT figure. If not, then 0. I think this might work. And then we want to subtract beginning minus usage. And then this is just going to refer to that. Then we can copy this. Ooh, it needs to be, oh, okay. We need to add a max thing. So if it's greater than 0, then max of that or max of either that figure or the max of the EBIT minus the beginning. I think this will work. Okay, that did not work. Okay, so what I'm trying to do is, okay, so if the beginning net operating loss is greater than 0, then you want the max of either what's remaining or, no, you want the min. Yeah, this is actually something that I would work on all the time in banking. You're trying to figure out like what formulas are correct and stuff. So I-48 minus the beginning. Okay, nope. That's not right. I-48 or okay, let me start this from scratch. So equals if the net operating loss is greater than 0, then you're either going to want this you want the EBIT to become that or max of that or let me start from here and then work towards it. So okay, I might need another if function. So max of either I-48 or if basically this formula I-48 minus that is greater than 0, then do I-48 minus I-54. It's not. It's less than 0. 0. Dang it. I think I'm getting closer though. Okay, so, oh wait. I-48 minus I-55 is less than 0. If it's negative, then what we want is I-48 minus I-54. Oh, this is what drives me crazy. Okay. Basically what I need is this for this to be 41. And for this to get to 0. I remember there was like a formula I used to use for this, but I cannot remember what we used to do. So bear with me as I figure this out, basically. So equals if, okay, beginning net operating losses, then usage depends on how much we have left. So, okay, if our beginning net operating losses is greater than our EBIT, that means it's negative. If our beginning operating losses is greater than our EBIT, then we will want that means we have net operating losses left over. Then we will want our EBIT. Otherwise, we'll want our beginning net operating losses. So if 54 is greater than 48, then we will want 48. Otherwise, if beginning, okay, let's see. I see someone has helped me out here. So let's see if this one works. So equal if you see beginning plus usage, ending. I don't know if that's going to work. We're trying to fill out the ending one here. So I-54 is greater than I-48. So you have operating losses. If it's greater, then you want to use your EBIT. If you run out, then you want to use the amount you have left, which is your operating losses this minus that. Okay. You have operating losses greater than just use your EBIT. If not, then let's say it's zero. Oh, this might work. Min EBIT or beginning loss. Oh shit. Okay, good job. Thanks, Chloe. I don't know why this was so hard. Okay, but I think this might work in this scenario. Okay, I was definitely overcomplicating things. But if we use, let me think through this. If we use the minimum of our EBIT or our beginning operating losses. Yeah, actually this works. Thank you. Wow, okay, I was definitely overcomplicating things. But basically, so this helps us figure out what our tax rate should be. So next, that's what we're kind of working towards this whole time. So basically, if at this point, if we have NOLs available, our taxes are basically, so if this is greater than 0, then we have 0 tax rate or 0 taxes. If it's not, then it's our EBIT minus our NOLs. Wait, no, minus our usage of NOLs. This should work. Cool. All right. Wow, that took forever. We can also copy paste this across. Also want to caveat, this is kind of a very dirty way of doing NOLs. I don't 100% know. There might be a better way, just FYI. Oh, sorry. This is actually not our taxes. This is what our EBIT would be. So let's call this EBIT applicable to taxes. And then, so our actual taxes we're going to need to have down here. And then, so we can just kind of assume a tax rate. I think I'm not going to sensitize this because we don't need, I don't think, we'll just use like a typical US corporate tax rate right now, which is 21%. So this again is going to be a little bit dirty, but oh well. So it's going to be 0%. So equals if this is greater than or equal, let's say less than 0. Well, yeah, if this is equal to 0, then 0%. If not, 19% or 21%. Although they're probably going to have like a tax rate less than 21%. But who knows? Maybe the tax rate will increase in the future. Anyway, so now we can get our EBIT times our tax rate. Okay, and it's not a huge number anyway. All right, so that gets us to our EBIT, which is our earnings before interest after taxes. So let's get our EBIT, subtract our taxes. And then we have our cash flow items. So D&A and CapEx are pretty much going to cancel each other out. But we'll have them anyway. Okay, so then Also not going to sensitize for DNA or CapEx. So I'm just going to take an average of what we have in the past 4 years since we have that data. And I'm going to do the same thing for CapEx. And then change in net working capital. Actually, to keep things consistent, what I'm going to do is actually do the past 3 years, because that's what I also want to do for our change in net working capital, since it's pretty lumpy. And this is going to be multiplied to our sales of the year. Oops. Okay, so wait, should we be subtracting this positive figure? Change in net working capital for Reddit is a negative figure. It's cash outflow. Outflow, inflow. Inflows are lower. Receive this money, paying this money. Okay. Subtract the negative. So these should actually receiving money to receive. That should actually be a cash inflow. I'm going to actually make these not negative. Okay. All right. Someone can double check me on this, but it seems like basically changes in working capital are cash outflow for Reddit, and normally companies, let me double check this. It's been a while since I've thought about this. I should probably know this by heart now. Negative figure. Normally with working capital, cash outflow. Subtract out changes in net working capital. So unlevered free cash flow, present value of free cash flow. Got to figure all that out. Basically your EBIT plus your DNA minus CapEx minus change in net working capital. Let me think about this change in net working capital. So first of all, the number seems a bit high. Change in net working working capital. Okay, actually, since this is a cash outflow, I'm going to change this back. Sorry about that. Okay, so basically your net working capital is the amount of cash you're spending in order to keep the business operations kind of going. And it's a cash outflow for Reddit, so it should be subtracting out rather than adding to cash flow. And I also think these figures are so high. I think it's hugely impacting our cash flow here. We are in our conservative case though. So, but maybe, okay, let's see what our base case looks like. A little higher, but still pretty low. Okay. Maybe terminal value will be high. Okay. 6% versus 2 to 4% in the past few years. Feel like might be a little high to do that. So I'm going to take an average of the past 2 years instead. Okay, 3%. Okay, so now we have our free cash flow. We're going to next need to calculate our WACC. So let me do that. I'm going to take from a previous model I built. I have the formula up here in case you guys aren't familiar with what WACC is, but we're calculating our discount rate. Let me zoom in for you guys. Current market cap, oops. For Reddit. One sec. I'm just checking my phone for something. Okay. So where was I? Let's calculate our WACC. We're going to first get our market cap for the company. Loading. All right, so fully diluted market cap, 8.959 billion. Company has 0 debt, so this is gonna be pretty easy, I think. Okay, market cap, 8,959. So this is all in millions. And then risk-free rate is our 10-year treasury yield. Treasury. .673%. Beta is super. Oh yeah, well it's super high because it recently went public. So I don't know if this is the most reliable, but we'll see what it spits out. Let's also get our equity risk premium. .13%. 18% WACC. That is crazy. Yeah. So the beta is super, super high because the company has just gone public, and I wonder if Yahoo Finance has beta for Reddit. I imagine it's going to be probably something similar. So a little tricky. Beta, yep, does not have. Dang. I think what we would probably have to do is find a similar set of companies and use like unlever beta, relever beta, figure all that out. But that's going to take a lot of time that I don't have right now. So I think typically what you would expect for a company of Reddit's size, about like 9 billion tech company with its growth rate, probably something similar to a company like Uber-ish. And I would probably let's say the beta, if probably something more like 1.5x over time, and like around 11%. I think like that makes more sense. Like I think the beta probably will be, so basically this is like how much more how much more in order of magnitude are you more volatile than the stock market? And Reddit, I think, would be somewhere between like 1.5 to 2, maybe actually like 1.75, like 12%-ish. So I'm just going to add a comment here that this is like estimate given Reddit just went public. So for example, let's maybe look at some other similar companies and see what their betas are. So if we go to similar companies, Snapchat might be a good one, although Snapchat's probably like, beta's probably pretty high. $1.55. Okay, so even Snapchat's 1.55. So maybe it should be a little bit lower. So let's also look at Roblox. Also relatively volatile company. Oops. Roblox beta, oh, it didn't load yet. 1.62. Okay, so 1.7 probably too high. Maybe 1.5 does make sense. Okay, so around 11% or so, right? So instead of relying solely on like our WACC calculation, but hopefully it's helpful for you to kind of see what this all looks like. I think what makes more sense is just going with what like roughly like instead of exactly 10.87%, I think 11% makes sense for our base case, optimistic case 10%, and then a very conservative case 12%. And we'll use the choose function. Oops. All right, Fernando in the chat, I see. I have made the calculation based on peers by unleveraging the beta, attaining an average relevering. Beta was 1.34%, achieved 9.6% WACC. Okay, so I mean, I'm okay with lowering it a little bit, but I think even if we were to use, let's see, 1.34, 10.2%. So I think the numbers might have changed a little bit since maybe when you were calculating this. Maybe I don't know what your risk-free rate was or your market risk premium. But I think for now, because the company is public and it's pretty risky, I think something like 1.5 is makes a little bit more sense. Now, with that said, maybe we meet in the middle a little bit. Call it 9. I'll have our optimistic case 9.5% WACC. And then conservative case 11.5%. Terminal growth rate 2.5%, 3%, 2%. All right, so now we can calculate, and now we have to use mid-year convention. Let's go down, down, down. Okay, present value of free cash flow. We're gonna have to figure out our discount period. So what we're gonna do here is basically, this is really all, if you were to take the end of the year cash flow, then it kind of basically like over discounts the first year that you're projecting. So show you what I mean. End of year. Okay, so in this first year of our projection, we want to figure out first how much of the year we have left. So essentially, using our year frac formula, we get our start date and then our end date, which is C6, the last date of 2024. So we have 68% of the year left. And what we want to do is get our cash flow in the middle of this year, or middle of the remaining months in this year, which I guess since it's April, late April, somewhere around like August-ish maybe. So we want to divide this by 2 basically. And then, so this is basically saying we want to discount our first year's cash flow by 0.34, or wait, let's see. First of all, we only actually, our free cash flow remaining is not the full, I guess, negative 25 million here, but 68% of that. And we want to get that in 0.34 years from now. So let me just show you what this all looks like. So first of all, we want to get our 68% of the year left. Like, we don't care about cash flow that's already happened. We only care about cash flow that's happened right now, or that's going to happen in the future. So we have 68% of the year left. So we actually don't want to take 25 million and then discount that back. We want 17 million. And then we also don't want to discount it by the end of the year. We actually want to discount it in the middle of the rest of 2024. And the number of months left from now until the middle of the number of months left for the end of 2024 is 0.34 years. So that's equivalent of 124 days, which is around 4 months from now, right? Because we have about 8-ish months of the year left, I think. Okay, but anyway, so is that right? So this times 365 divided by 30, 4 months. So right now we have May, June, July, August, September, October, November. Oh yeah, that's right. We have 8-ish months left. So what we want to do here, first of all, what I'm going to do is name our cells here WACC, terminal growth rate, although we might do exit multiple method. So we want to get our cash flow and then divide by 1 plus our WACC to the power of the year that, or of our discount period. So this discounts back by a little bit. And the reason you want it in the middle of the year is because you're getting free cash flow every day throughout the entire year as a company, or losing it, I guess, in this case. But in order to make a simplifying assumption to say that instead of discounting at the end of the year, which heavily hurts your free cash flow calculations and your present value of free cash flow calculations, you're basically saying, I want to make a simplifying assumption that we get all our cash in the middle of the year. It's just like something that bankers do. It's not really that sophisticated either. Okay, so next what we want to do is, so since we have 0.68 amount, or that's the amount of years we have left in this year, what this basically represents us getting to the end of 2024. So 0.68 years left. And then we want to get in the middle, our cash flow is in the middle of 2025, which is in the end of June, right? So that's simply your period, the amount of years left or whatever, plus 0.5 years. So this basically is our discount period for 2025. And then, so this gets us to June, end of June 2025, and then you add 1, June 2026, etc. So now at this point, you can just keep adding. So next, we just calculate now we just discount back. So 1 plus our WACC to the power of our discount period. And then keep doing that for these cash flows. Okay, so now, now that we have our free cash flow, we need our terminal value and present value of terminal value. And that'll get us to our enterprise value. Then you add cash, subtract that, which is 0. That gets you to your equity value. Then you get your fully diluted shares outstanding. And then that's how you get to your implied share price. And so terminal value, let's see, kind of talked about how we wanted to maybe do exit multiple in the agenda here, but let's see if there are actually any multiples we can use, because they're kind of all over the place. Maybe like a 15, 16x. Maybe that does make sense. 12 to 16. Let's see what we have for EBIT margins here. 25% in 10 years. Okay, so okay, I wanted to format this nicely, but I don't think I'm gonna have time. I have to leave in really soon, in like 10 minutes. So what I'm gonna do here is have perpetuity growth method and then exit multiple method. So for perpetuity growth method, it's pretty simple. It's your last year's free cash flow times 1 plus your terminal growth rate, all divided by your WACC minus your growth rate, terminal growth rate. And then you discount this by 1 plus your WACC to the power of your discount period. So that is what your terminal value looks like for using perpetuity growth. Exit multiple, let's call this terminal value, and then present value of terminal value. Exit multiple method, usually you use your EBITDA in 2033, then your multiple. That gets you to your terminal value, and then you have to discount that as well. So I guess we can, sorry this is not like gonna look that pretty, but oh well. So EBITDA is going to be EBIT plus your DNA. Multiple, we have our comps here. I guess we can use our mean here that we calculated. Well, actually, which year would you use? 2024 to 20. This is a really broad range. I'm gonna go with the median. So 13.8. So EBITDA times our multiple gets us to, yeah, crazy high number. Seems unrealistic. This divided by 1 plus our WACC. Actually, if we discount it, it might be okay. Oops, I messed this up. Okay, equals that divided by 1 plus our WACC to the power of our discount period. Okay, that actually could make sense. So what sometimes, honestly, when I was at JPM, I never used the exit multiple method. Maybe, yeah, even for companies that were like kind of like biotech companies. But I do know that some people, like what you like to do is take a percentage of the perpetuity growth and exit multiple method. So let's just call this percentage of each method. I don't know, very like on the nose description. And then I'm going to call this like, you know, you can use 50% for each. So with that, let's calculate our terminal value. That times, well, this is on actually like a very unnecessary calculation we're doing right now. So that times 50% plus that times 50%. And later on, if you feel like, oh, I only want to use the perpetuity growth method, then, you know, you can make that 100%, or the terminal value, you can make that 100%. So I got a question. Is this the way you were doing it when you were working? Like, definitely not in terms of where I'm putting these assumptions and stuff. I would move them to the top. And also, as I mentioned, I'd mainly stick with the perpetuity growth method. But I did mention in the beginning of this video, I wanted to show you guys the exit multiple method as well. So that's kind of why I'm doing both of these. Present value. Oh, oops. That's not making sense. Oh. All right. So now we have the present value of our terminal value, which I got an basically 50% of our perpetuated growth method and 50% of our exit multiple method. And then I'm going to sum these up to get our enterprise value, then add cash. So let's go to our balance sheet to see how much cash Reddit has. So at the end of 2023, it had 400 million in cash. So 401 equals 401.176 plus marketable securities 811.946. Debt, we looked earlier, there's 0. So let's get our enterprise value plus our cash minus our debt. Then let's get our fully diluted shares outstanding. Normally you would need to calculate this, but we'll just take what's on FactSet. So 721.1. And then this gets us to our implied share price. Okay, so we did it. That looks super, super low. Impossibly low, actually. Oh, this is the wrong company. Reddit. Oh, there is that, according to Fernando. Did I miss that? Let's see. Convertible preferred stock. Nope. Current liabilities, there is no debt here. Current operating lease liabilities, we don't count as debt. Other non-current total liabilities. So Reddit has no debt. In terms of fully diluted shares, 211. That gets to, oops. So that gets to a share price of $29.98, but that's not necessarily what I'm saying that it should be. So let's have implied share price, current share price, and then okay, Fernando, I see you say that is 1213. Yeah, shares might be basic shares instead of fully diluted. And then it's possible actually that Reddit recently raised debt over the past few months. So they could have that now, although I'd be kind of surprised if they did that. Because they just, well, they IPO'd, but I guess they didn't like necessarily raise money. Because they didn't do like a standard IPO. Yeah, okay. I don't see any like recent debt offerings, but I think it's okay, I'll do one more check somewhere else after I link this up. The implied share price about $30. We can see Reddit. Balance sheet. While that's loading, Reddit's current share price 45.43 as of the filming of this video. Let's say we look at our base case scenario. Everything is at 2. This is our implied upside or downside. Basically, what we have right now is if we believe in our base case scenario, which I think, given that we are kind of going with what the street thinks is going to happen. As a reminder, it's 24% growth goes down to 8%. I think that's like fairly reasonable as a base case scenario. And then the base street case kind of like goes up a little bit more slowly. Like you could argue NOLs are expiring soon, so the company's really going to ramp up to profitability. This is kind of like not steep enough, and so maybe like you should be more optimistic, which gets us to $43.14. If I were to, and let's say you argue like, oh, we should have a higher WACC. Terminal growth rate should be 2.5%. I think that's fine. So I guess in that scenario, if you're like a little bit on the optimistic side for Reddit, then you can say there's like 5% upside. I would say basically like this is roughly what I think kind of makes sense. So to my surprise, I think Reddit is actually relatively trading where it should be. But a lot is going to really depend on how the company executes in the future. Let's say we were like looking very, very optimistic, conservative, then there's like a ton of downside. Also possible if like AI eats Reddit's business and all that. If we're on a super, super optimistic end of things, then we say that there's like, 32% upside potential, which actually I don't think is really that great, given that our optimistic scenario is like pretty aggressive. So I actually think this also tells a lot that no matter, even if you're extremely, extremely optimistic about Reddit, based on the information that we have right now, like maybe in like, even next week, Reddit could come out with something that just totally transforms the business in a good way. So these numbers could be completely off, but based on the info right now, it seems like even if you're extremely optimistic, there's not a ton of upside. And then if you're just kind of more base case, there's quite a bit of potential downside. So seems like not the best investment in my opinion. Now with that said, of course, if like Reddit trades down to something like $10, then it could be a super, super great investment. So, we'll have to kind of see what happens with the company, and especially since the company is new, recently started trading in the public markets, there's going to be a lot of volatility. But yeah, that pretty much wraps up the DCF for Reddit. Was an interesting one because there was that wrinkle with NOLs, which I really haven't done in a while. So I'm going to also have to double check that I did everything correctly. This is going to be uploaded fairly soon, hopefully in the next 1 or 2 days. So there will be a link for that in the description. Also, as a friendly reminder, if you want to look into the Wharton Wall Street Prep Buy-Side Certificate Program, which I won't go over in detail again, but I did in the beginning. It's kind of like a hedge fund and buy-side investing certificate program. And you can use my code RareLiquid to get 30% off, $300 off. And it's taught by Wharton professors. There's keynote speakers from people like Howard Marks, a legendary investor at Oaktree. And then you'll learn a lot of things like fundamentals of investing, buy-side modeling, thesis development, and etc. So feel free to check that out. I'm leaving a link to that in the description as well. So yeah, I got to get going, but hope you guys enjoyed the stream, and I'll catch you guys in the next one. Thanks and peace.